Investors are often unsure where they need to put in their money throughout various economic cycles. It can be hard to pick an investment when there are numerous multiple viewpoints about what the future will hold. Some claims to buy gold and some claims to hang on to money and not to buy anything, since you never know what will happen in the economic situation. Others recommend remaining to do what you have done before and keep purchasing the same investments, whatever. Well, there will certainly constantly be fluctuations, and also it's impossible to predict future markets. Some investments have a lengthy record of profitability, making sure to execute well in the long run. Without much further evaluation, can you lose money if the marketplace takes a nosedive? Absolutely. However, it's safe to state that some investments will execute more than an extended period. This kind of ETFs are great to purchase and hold forever without ever before requiring a sale, as well as they are all available from several companies. But before we start, welcome to our channel. Make sure to subscribe to the channel. Don't forget to click the notification bell so that whenever we upload a new video, you will be updated and you can start to make things happen. Also, please give this video a big thumbs up. If you have any concerns, questions or opinions about the video, leave a comment down below. Now let's get back to the video. Warren Buffett suggests that most people place most of their portfolio on one fund, the S&P 500. Putting almost all of your portfolio into one fund might sound risky and highly focused on some people. However, consider that this single fund holds over 500 different big cap American businesses. So, you are basically buying the American economic climate. Although rates might seem like they are high right now, it's hard to lose money using this investment vehicle over the long term. Besides, there is a chance that the marketplace could steadily climb forever and there will never be a significant drop once more. The dividend return alone is about the same price made with the savings account. It's currently around 2%, even as the marketplace is near an all-time high. Among the reasons that the S&P 500 is such a fantastic financial investment is because its holding should meet specific demand and also guidelines. It implies that each holding should be a US business. It should be a big cap company with a value of $5.3 billion or even more. The company should have constant positive income reports, especially the past 4 orders, and it needs to be trading at a sensible share rate. These requirements assist in protecting investors. Large blue chip companies tends to be highly stable stock that weather well throughout hard times and they pay steady dividends. Likewise, it's most likely that you make use of most of these companies' products and services regularly, as their services and products are found almost everywhere. The largest holdings include Alphabet, Johnson & Johnson, Microsoft, Apple, and more. Vanguard's VOO is extremely low priced regarding cost. However, different firms offer numerous others. Buying the entire stock market or merely a huge quantity of companies is an additional security option that can be held as well as never sold. An item such as Vanguard's Total Stock Market ETF VTI has over 3,600 different US companies of numerous size. Rather than one holding massive, mature and steady stock, there are several smaller holdings that you most likely never come across. This offers even more exposure to different companies that may have the extra potential for growth. Small cap holdings can be desirable compared to various other funds stated all loan companies of similar size. However, a number of bigger holdings are the same. VTI's top holdings include Microsoft, Amazon, Berkshire Hathaway, and also Procter & Gamble. You can expect to get a dividend return of around 2% in a price of return comparable to the S&P 500. However, the extra diversity would undoubtedly be the primary reason for choosing to include this in your portfolio. Real estate is a fantastic financial investment for numerous reasons. Acquiring a real estate ETF such as Vanguard's VOO or perhaps a real estate stock enables you to get more exposure to the sector. People will certainly constantly need shelter, whatever. There is a reason 90% of world's millionaires have developed their wealth with this investment. Technology, energy, healthcare, and other sectors can have a much less particular future for several reasons. It could be due to government regulation, new improvements, or competition. But real estate is something that we can state with a high degree of assurance that we will constantly require. Although real estate funds are not restricted to homes, they buy apartments, hospitals, hotels, storage real estate loans, and basically every sort of real estate. This need for property additionally offers security combined with high dividends that REITs pay. The reason for this is since financiers seek high-yielding stocks when the economy is uncertain. Dividend yields for a refund are commonly 3% or even more. In Vanguard's return concerning 3.5%, it's not suggested to assign your entire portfolio to the real estate market, but you think about including a position to supplement your investments. A customer staples fund is another that will undoubtedly be profitable forever. The stocks are non-discretionary business that produce essentials. Consider purchasing all various companies that make laundry detergent, food and drinks, garments, other household items. These companies are generating cash regardless of present financial circumstances and often tend to perform much better when times are difficult. Businesses like Walmart do very well as many people try to cut back and buy products there instead of much more costly stores and items. Additionally, tobacco and alcohol firms are taken into consideration staples. There are combined feelings for the future of these sales and often tend to enhance when times are bad. Besides, if they fall out of favor, they would likely be removed from significant funds. Similar companies include Procter & Gamble, Coca-Cola, Constellation Brands, and Walgreens. Purchase BDC with Vanguard at an affordable or research a similar fund with various business. The S&P 500 Growth Fund is excellent for more youthful capitalists who have more time before drawing from their portfolio. This is because growth stocks are commonly more unstable, meaning they perform poorly throughout imperfect markets. Alternatively, they grow and also appreciate faster than older established income stocks that have expanded to a level where they have plateaued to some degree. When the stock market is near all-time highs, spending heavily on new growth stocks can be a little bit more risky than income stocks. However, if you are young and don't require to touch that money for a very long time, the possible earnings can be higher. The dividend return for the growth S&P 500 fund is fairly reduced at concerning 1%. This is because these fast-growing companies are less likely to distribute incomes to investors, and they are more likely to reinvest earnings to sustain growth. Yet, at the very least, you will be getting some regular payments as your cash expands. Although growth stocks carry a higher degree of unpredictability, remember that each holding is still a part of S&P 500, meeting all of their requirements including size and profitability. Growth funds are also the referral of Dave Ramsey, who states a 12% annual return is entirely achievable. Anyone who recognizes anything about Dave Ramsey knows he is a highly conservative person during investing. He even recommends paying cash for rental properties. When the stock market goes lower, the very best thing to do remains to dollar cost average investing the same quantity of cash regularly. This affords you the capability to be emotionless with your investments and take advantage of lower valued properties. Selling when the market is doing badly can be one of the worst points you can do, as several financiers who did this back in the Great Recession wound up losing around 50% of their money. These same capitalists were frightened of the stock market for a long time and only began purchasing once again after the market had achieved a lot of its growth. Throughout that period is when consistent investors profited tremendously. It is essential to invest with a long-term mentality. So, worrying about the economic situation for the following years is not practical. Instead, purchase solid investments such as this that supply diversity and stability. It executes well in the past as well as is likely to perform well for several years. After all, it's not about the exact investment you choose. However, the act of saving and investing continually over a long period. As always, thank you for watching. I hope you gained some value out of this video, and that's it. Before we go, make sure to subscribe to the channel, click the notification bell, hit the like button, and I will see you in the following videos.